Kelly, Peter and Damien are equal partners in a partnership that offers software development services. The partnership's assets include office premises as well as purchased goodwill, and their annual turnover is approximately $1 million. For several reasons, including asset protection, they are considering converting their business from a partnership to a unit trust, but first want to know what the CGT implications will be. Generally, a capital gain or loss would be made when transferring CGT assets. However, there are many types of rollovers and relief available in the CGT provisions which first need to be considered. The main effect of a rollover in most situations is to defer the CGT liability until a subsequent CGT event occurs sometime in the future. The company rollover applies when assets are transferred into a company. The first condition for using the rollover is that an individual, a trustee, or all the partners in a partnership transfer assets to a wholly owned company. Secondly, the consideration for transferring such assets must be the receipt of non-redeemable shares in that company. Lastly, these shares must be of the same market value as the transferred CGT assets. The effect of this rollover is, firstly, that there will be no CGT liability upon transferring the assets to the company. Secondly, the assets in the hands of the company will have the same tax attributes as they did prior to the transfer, including the same cost base, reduced cost base, and pre-CGT status if applicable. Thirdly, the cost base and reduced cost base of the shares in the company will be equal to the value of the transferred assets. And lastly, if the transferred assets were pre-CGT assets, then the shares in the company will be too. Replacement asset rollovers apply in certain situations where one asset is replaced for another. For instance, if a taxpayer has an asset that was compulsorily acquired and is given a replacement asset, this would be one situation where a replacement asset rollover could apply. The effect of a replacement rollover applying is that firstly, any capital gain or loss is disregarded, and secondly, the replacement asset takes on the tax attributes of the original asset, including the cost base, reduced cost base, and pre-CGT status if applicable. The Small Business Restructure Rollover is a broad rollover aimed at transferring a small business entity's active assets from one structure to another. Active assets are generally those used in the course of business, as well as intangible assets inherently connected with the business. Active assets generally do not include assets such as rent-earning residential property. Specifically, the first condition for this rollover is that the relevant entity is an SBE or related to an SBE. Secondly, the restructure must be a genuine one, not one that is contrived or unduly tax-driven. Lastly, there must be no change in the ultimate economic ownership, which means that the ownership interests before and after the transfer should remain the same. For Kelly, Peter and Damien, the partnership would be an SBE due to running a business and its turnover being below the relevant threshold. They also appear to have genuine reasons for this restructure, such as asset protection. If they each owned 1/3 of the units of the resulting unit trust, then this would fulfill the requirement of there being no change in the ultimate economic ownership. This is because they were originally 1/3 partners, so this keeps their economic ownership equal. Demerger relief is a rollover that applies when a shareholder owns shares in a company or trust, and a demerger by that company or trust leads to the shareholder receiving new or replacement interests in the demerged entity. A demerger generally involves the splitting of a company or business into multiple entities. In this case, the ultimate ownership of the interests remain the same, but the business or businesses are now operating under a new structure. Demerger relief ensures that no capital gains or losses are triggered for the members upon the restructure. Same asset rollovers apply in some situations where an asset is transferred from one taxpayer to another. For instance, such a rollover would apply where, due to a divorce agreement, there are assets transferred between the divorcing couple. Where the same asset rollover applies, then the consequences are similar to the other rollovers. Any capital gain or loss due to the transfer is disregarded. Also, the transferred assets have the same tax attributes as they did prior to the transfer, maintaining their pre-transfer cost base and reduced cost base and pre-CGT status if applicable. To recap, there are a variety of rollovers and relief available. The overriding principle is that certain transactions that meet the relevant criteria do not trigger CGT liability, effectively delaying any CGT implications to a future event. Further, the assets held after the rollover generally have the same tax attributes as those held prior to the rollover. This ensures that subsequent transactions occurring on the post-rollover assets would have similar CGT consequences as if they had occurred to the pre-rollover assets.